Welcome to Currency Secret, your guide to the latest moves in gold, silver, and the US dollar. The silver trap wasn't an accident, it was the dollar system. Looking for oxygen? The silver crash wasn't a market event, it was a function. It was the dollar system, under stress, pulling oxygen out of every other room in the building to keep its own lungs working for one more cycle. When that happens, the most liquid paper markets get used as shock absorbers, not because they're weak, but because they are available. Silver sits at the intersection of two worlds, monetary metal and industrial input, and that makes it perfect for this kind of operation. The drop was not simply fear, not simply positioning, not simply risk off. It was a predictable mechanical phase inside a repeating pattern that has played out for a century. When the reserve currency complex tightens, it demands collateral, it demands dollars, it demands settlement, and it forces a liquidation cascade that looks like a verdict on value when it's really a plumbing event. Recent estimates routinely put global debt above roughly $300 trillion when you combine sovereign, corporate, and household liabilities, and derivatives notional in the hundreds of trillions more depending on how you count it. You don't need the exact number to understand the math. A system that large cannot rebalance smoothly. It only rebalances through discontinuities, and those discontinuities are not random. They happen in stages, like a machine cycling through gears. Here's the mechanism, and it is boring in a way that should terrify you. First, there is a setup phase. The architecture is built, the rules are written, and the incentives are aligned. Then comes expansion. Credit grows faster than the real economy. The currency is stretched, and promises multiply because the cost of making promises is artificially suppressed. Eventually, you hit crisis. The system loses control of either price stability or funding stability, often both, and the authorities discover that confidence is a resource you can spend but cannot print. Finally, the inevitable outcome arrives. A reset in claims, a repricing of collateral, and a migration toward the assets that are outside the promise stack. The exact labels change by era. The math does not. The trap is that the crisis phase often begins with assets that should rise falling violently instead, because in the crisis phase, the dominant demand is for liquidity, not for value. Value only wins after liquidity has finished eating. Start with the most famous modern example because it shows the blueprint with the least ambiguity. The United States from the late 1960s into the early 1980s, with the Nixon shock as the hinge. The setup was Bretton Woods after 1944. The dollar became the anchor, convertible to gold at $30 per ounce, with other currencies pegged to the dollar. That wasn't a moral arrangement. It was a funding arrangement. The U.S. exported dollars through trade deficits, military spending, and foreign investment, while foreign central banks accumulated dollars as reserves. It worked as long as the stock of dollars abroad did not overwhelm U.S. gold reserves at the promised price. That was the setup, a system of fixed exchange rates built on a single convertibility promise that required discipline the politics could not sustain. Then came expansion and debasement. By the 1960s, the U.S. was running persistent deficits, and the Great Society spending plus Vietnam accelerated the fiscal impulse. Credit growth and government spending were not matched by a commensurate rise in productive capacity. Dollars accumulated abroad. Foreign governments, notably France under de Gaulle, openly questioned the arrangement and demanded gold. The eurodollar market, dollars created and lent outside the U.S., expanded the dollar supply beyond what the domestic monetary base suggested, and that offshore dollar creation diluted the meaning of convertibility even further. The system was stretching. More claims on gold, more claims on dollars, more leverage layered on top of a fixed price promise. In that expansion phase, currencies and commodities start whispering the truth before policymakers admit it. Gold pressure builds. The dollar's external credibility erodes. Inflation pressures become embedded as expectations shift. Crisis and loss of control arrived in 1971. Nixon closed the gold window, ending convertibility, an admission that the promise could not be met. That decision was not just about gold, it was about the entire structure of the dollar's role. Once the anchor was removed, currencies had to find new equilibrium levels, and inflation became the outlet valve for years of overextension. The 1970s delivered stagflation, weak growth with high inflation, because the system was trying to reconcile excess claims with real-world constraints. Oil shocks in 1973 and 1979 amplified it, but the underlying issue was monetary and fiscal regime credibility. Bond markets didn't behave politely. Yields rose because lenders demanded compensation for inflation and for uncertainty about the currency's purchasing power. Funding costs tightened, volatility surged. If you want to see the crisis phase in one picture, it is the bond market refusing to lend cheaply, and then the inevitable outcome, the Volcker tightening. By 1979-1982, the Federal Reserve pushed rates high enough to break inflation's back, but the price was a brutal recession and a repricing of assets. That was the reset. The system had to cleanse itself through higher real rates, bankruptcies, and unemployment, because prior promises had become too large relative to the economy's capacity to honor them in stable dollars. Now look at what the monetary metals did through that entire arc. Gold rose dramatically across the decade, peaking in 1980. Silver moved even more violently, because silver's market is smaller, thinner, and more prone to squeezes and cascades. But crucially, there were violent sell-offs inside that larger trend. Moments where liquidity demanded liquidation even of the assets designed to protect against debasement. The crisis phase is when safe havens get sold to meet margin calls. That is exactly the trap dynamic you just watched in silver. Paper price collapses while the underlying function of the metal, as a pressure release for currency credibility, only becomes more important. You can map the mechanism precisely. Set up Bretton Woods and gold convertibility at a fixed price. Expansion, deficits, eurodollars, rising offshore dollar claims, policy choosing growth over discipline. Crisis. Gold window closed, inflation regime breaks, bond market revolts, FX realigns. Inevitable outcome, Volcker reset, credibility restored only through pain, with metals having already signaled the breakdown. The lesson is not gold goes up. The lesson is that the crisis phase forces liquidation first, then reprices truth later. Now take a second case study that feels different on the surface but is structurally identical. Britain's pound crisis and the collapse of the post-war sterling order, culminating in the 1967 devaluation and the 1976 IMF crisis. After World War II, sterling still carried imperial prestige, but prestige is not collateral. The setup was a world where Britain tried to maintain a global currency role with a domestic economy weakened by war costs, reconstruction burdens, and a shrinking competitive base. The pound was pegged within the Bretton Woods framework, and Britain repeatedly promised stability. That promise required reserves and credible policy. Yet Britain faced chronic current account pressures, industrial stagnation, and a political reluctance to impose austerity at the scale required to defend the peg. Expansion and debasement in this context wasn't printing money in a cartoon sense. It was the accumulation of liabilities and policy compromises that eroded confidence. Britain ran balance of payments deficits, relied on external borrowing, and leaned on swap lines and support packages to defend the pound. Each defense bought time but increased the system's fragility. Markets learned the rhythm. The authorities would promise, defend, and then ultimately adjust. That learning is itself a form of debasement. Confidence is diluted. The crisis phase arrived when the market stopped believing the defense. In 1967, Britain devalued the pound from 280 to 240. A devaluation is not a number change. It is a confession that the previous claims on purchasing power were too large. Once the confession happens, it changes behavior. Capital seeks exit routes. Domestic inflation pressures accelerate because imports become more expensive and wage negotiations adjust. Bond yields rise because lenders demand protection. The funding market begins to treat the sovereign not as an unquestioned borrower, but as a credit that must pay up. By the mid-1970s, global inflation and oil shocks collided with Britain's structural issues. Sterling weakened again, confidence declined, and in 1976, Britain went to the IMF for assistance. Another public signal that the system had lost control of its own funding conditions. The inevitable outcome was a forced policy shift, fiscal restraint, tighter monetary conditions, and acceptance that sterling could not simultaneously serve as a global reserve-like currency and fund domestic political promises without consequence. Again, the reset was not optional, it was mathematical. When the external funding constraint bites, the currency must adjust, the bond market must reprice, and the economy must absorb the cost. And again, look at the parallel with today's trap dynamics. The crisis phase pressures everything liquid. The easiest assets to sell get sold first. That includes paper claims on safe assets because in the moment of funding stress, the only safe asset is the one that settles the margin call. Now bring it back to metals, because the metals market is where the paper vs physical split exposes the lie. Silver and gold trade in two overlapping realities. One is paper, futures contracts, unallocated accounts, derivatives, claims on metal that can be rolled, netted, and cash settled. The other is physical, bars, coins, industrial inventory, refinery output, and warehouse stocks that can actually be delivered. During a liquidity squeeze, paper prices can be driven down by forced selling, by CTA trend mechanics, by dealers hedging, and by the simple need to turn anything into dollars. But physical flows do not obey paper narratives. When confidence cracks, people demand the thing itself, and the system has to reconcile a mountain of claims with a comparatively small pool of deliverable metal. That reconciliation is where premiums rise even while spot falls, where inventories draw down even as headlines scream crash, where delivery requests become the real signal and the price becomes the propaganda. This is why I call it a trap. The trap is psychological. People think the price move is information about fundamentals. But it is also structural. People confuse the paper price discovery mechanism with the physical supply-demand mechanism. In the crisis phase, the paper mechanism is dominated by collateral flows. If bond yields are rising and auctions are going poorly, the system needs balance sheet. If funding markets widen, repo rates, swap spreads, cross-currency basis, then dollars become scarce at the margin. Scarcity at the margin is what drives violent repricing. And when the dollar is scarce, everything becomes collateral, everything becomes for sale, even the assets that are about to become the exit. So we have the mechanism proven twice. In two different national stories, a reserve currency breaking its anchor and paying the price through inflation and a Volcker-style reset, and a former reserve currency losing credibility, devaluing, and eventually being forced into external support and domestic restraint. In both, the setup looks stable, the expansion feels like prosperity, the crisis begins with funding stress and credibility fractures, and the outcome is a repricing of claims and a migration toward assets outside the promised stack. Metals do not move in a straight line through that path. They whip because the crisis phase sells them before the outcome phase rewards them. Now look at the moment you are living in. You can feel the system searching for oxygen. You can see it in how quickly risk assets snap when yields jump. You can see it in how currencies gap when dollar funding tightens. You can see it in how one bad auction can ripple through volatility, spreads, and positioning. And you can see it in the behavior of silver, the kind of flush that makes people swear off the trade right before the structural pressure forces the opposite move. The next step is not a prediction. It is a sequence. We've already watched the setup and the expansion build the overextension. We've already seen the crisis dynamics begin to surface in funding markets and in the way liquidity disappears when everyone reaches for dollars at the same time. The only question left is how the present-day machine expresses its inevitable outcome, and why silver, specifically, is positioned to be the pressure valve when the system runs out of clean exits. The setup began in the early 1990s across Thailand, Indonesia, South Korea, and others. High growth, capital inflows, and exchange rate regimes that were either pegged or tightly managed against the dollar. The promise was stability. The incentive was leverage. Domestic banks and corporations borrowed in dollars because it was cheaper, because the peg made FX risk feel theoretical, and because global lenders were eager to recycle dollars into fast-growing economies. That created the foundation, a balance sheet structure where liabilities were in dollars while assets and revenues were in local currency. It works only as long as the exchange rate holds and dollar funding remains abundant. Then came expansion and overextension. Credit boomed. Real estate and equity markets inflated. Current account deficits widened in places like Thailand as imports and investment surged. Short-term external debt rose because it was easy and because maturity mismatch is invisible in good times. The debasing element wasn't printing, it was the quiet multiplication of promises, dollar promises, without matching dollar earning power. The system stretched itself into a position where confidence, not capital, was the real reserve. Crisis arrived fast because that's what currency regimes do when they break. In 1997, pressure built on Thailand's baht as investors questioned the sustainability of the peg and the size of reserves relative to external liabilities. Authorities defended until they couldn't. When Thailand floated the baht in July 1997, the confession became contagious. Markets immediately repriced the probability that every similar promise was also unpayable. FX collapsed across the region. Dollar debts, measured in local currency, exploded overnight. Domestic interest rates spiked to defend currencies, which crushed growth and credit quality. Funding markets seized because no one wanted to roll short-term dollar exposure into collapsing FX. This is the critical moment. What looks like an emerging market story is actually a dollar story. When the world scrambles for dollars, the reserve currency tightens, even if the Federal Reserve hasn't moved a single basis point. The inevitable outcome followed the same pattern you saw in prior case studies. Forced deleveraging, IMF programs and conditionality in some countries, restructuring, and a brutal repricing of assets and claims. But notice what happens in the aftermath of these resets. Once the forced selling exhausts itself and the system is recapitalized, hard collateral and reserve assets regain their bid because confidence has been broken in the promise stack. The Asian crisis was also a seed for future policy behavior. Many countries began accumulating massive FX reserves afterward, a structural shift that reinforced the global dollar system and created new feedback loops into U.S. bond markets. The mechanism repeats because the incentives remain. Now bring the mechanism into today, step by step, where the dollar system is not just a currency, but the settlement layer for global finance. The first present-day step is the setup. The world is built on dollar invoicing, dollar debt, and dollar collateral. Banks fund in dollars. Corporations issue in dollars, emerging markets borrow in dollars, commodity trade clears in dollars. Even when assets are local, the marginal funding and hedging often runs through dollars via swaps. This is why the dollar is not merely a unit of account. It is the oxygen tube. When oxygen tightens, everything gasps at once. Check. The second step is expansion and overextension. Years of low rates and abundant liquidity encouraged leverage across the spectrum. Governments rolling larger deficits, corporates refinancing cheap, investors stretching into duration and credit, and systematic strategies building positions that assume liquidity will always be there. The expansion isn't only in headline debt, it's in the density of linkages, derivatives, collateral chains, maturity transformation, and the quiet assumption that you can always fund tomorrow what you funded yesterday. That assumption is the real debasement, not of the currency, but of risk perception. Verified. Now, the crisis mechanics in the present begin where most people never look: the Treasury market and the funding markets that sit beneath it. The U.S. Treasury is the world's collateral engine, and Treasury yields are not just rates. They are the price of dollar time. When deficits are large and refinancing needs are heavy, the government must auction enormous volumes across bills, notes, and bonds. The market's response shows up in boring statistics that matter more than any headline: bid-to-cover ratios, the share taken by indirect bidders, the tail at auction relative to when issued trading, and how much yield concession is required to clear. If demand softens, yields rise. If yields rise, duration losses hit balance sheets. If balance sheets shrink, dealer intermediation capacity falls. And when intermediation falls, volatility rises. This is how a sovereign bond market becomes a transmission mechanism for stress, not a refuge. Undeniable. As yields rise, you have to separate nominal yields from real yields and term premium. Real yields moving up tells you the market is tightening financial conditions in the most direct way. The inflation-adjusted cost of capital is rising. Term premium rising tells you something even more uncomfortable. Lenders are demanding extra compensation for holding long-duration promises, meaning confidence in policy stability is eroding. When real yields rise fast, risk assets reprice because discounted cash flows are brutally sensitive to the risk-free rate. Equity volatility spikes. Credit spreads widen. Liquidity thins. In that environment, diversifiers get sold because the dominant demand is to raise cash and reduce leverage. Check. Then you move one layer down into funding markets, where stress becomes visible before it becomes obvious. Repo is where you borrow cash against collateral, often treasuries. When the system is calm, repo rates behave, haircuts are stable, and collateral circulates smoothly. When the system is stressed, good collateral becomes scarce, haircuts rise, and the price of funding can gap. Swap spreads. Differences between treasury yields and interest rate swap rates. Signal balance sheet constraints and hedging demand. Cross-currency basis shows dollar funding stress for non-U.S. borrowers hedging into dollars. When basis widens, it's the market charging a premium for dollar access. These are not academic indicators. They are the dollar system coughing. Verified. Now fold in one of the most important modern amplifiers, the basis trade. In simplified terms, leveraged players buy treasuries and hedge the interest rate exposure in futures or swaps, capturing small pricing differences that look like free money until funding costs rise or volatility spikes. Because it is leveraged, it is stable until it isn't. When repo rates jump, haircuts rise, or volatility forces margin calls, the trade unwinds. That unwind means selling treasuries into a falling market, which pushes yields up further, which tightens financial conditions further, which increases volatility further. It is a self-reinforcing loop. And because treasuries are the collateral backbone, stress here bleeds everywhere. Equities, credit, FX, and commodities. Undeniable. Next comes FX, the visible symptom of an invisible funding problem. When dollar funding tightens, the dollar tends to strengthen, not because the US is strong, but because the world is short dollars through debt and hedges. Emerging market currencies and high beta FX can sell off quickly. Even developed market currencies can wobble if their rate differentials, growth outlook, or external balances look vulnerable. A stronger dollar exports tightening globally. It makes dollar liabilities more expensive. It pressures global trade, and it forces central banks into uncomfortable choices: defend the currency with higher rates and hurt growth, or protect growth and accept depreciation and imported inflation. Check. This is where inflation-deflation dynamics get confusing, because both can happen in sequence and both are part of the same mechanism. Dollar strength and rising real yields are deflationary impulses for risk assets and credit because they tighten financial conditions and compress valuations. But currency weakness outside the US is inflationary for those countries because imports, energy, and commodity inputs rise in local currency terms. That inflation can be sticky because it feeds wages and expectations, especially if supply chains and energy markets are tight. So you can have financial asset deflation alongside consumer price inflation. Exactly the boring but terrifying combination that breaks political patience and policy credibility. Verified. Now put debt rollovers on top of that. Governments and corporations don't pay off debt, they refinance it. When a large portion of the debt stock matures into higher yields, interest expense rises mechanically. For sovereigns, that means larger deficits just to pay interest, which means more issuance, which means more auctions, which means more reliance on a market that is already demanding higher compensation. For corporates, it means refinancing at higher coupons, which squeezes margins, increases default risk, and widens credit spreads. This is how a rate cycle becomes a solvency cycle. Undeniable. As the solvency fear grows, volatility becomes a funding variable, not just a market mood. Higher volatility increases margin requirements across futures and cleared derivatives. It forces risk parity and vol targeting strategies to de-risk. It pushes banks and dealers to reduce inventory because balance sheet is precious when uncertainty rises. All of that creates a liquidity squeeze, less depth, wider spreads, more gapping moves. And in a liquidity squeeze, the market sells what it can, not what it should. Check. Now we arrive at precious metals, where the trap you saw in silver makes sense. In the acute phase of a liquidity squeeze, paper gold and paper silver can drop hard because futures are liquid, because they are used for hedging, and because they are a source of cash when margin calls hit. But the physical market reacts differently. Physical demand can rise precisely when paper prices are falling, because the fall is interpreted as an opportunity by buyers who distrust the system. That's when you see premiums detach, coins and small bars selling above spot, delivery times lengthening, and inventories drawing down in visible warehouses. The paper market is a claims market. The physical market is a constraints market. Verified. Silver is uniquely explosive because it is smaller and because its supply-demand is tighter than people think once you strip away paper claims. Silver supply is not infinitely flexible. Much of it is produced as a byproduct of mining other metals, which means supply does not instantly respond to price. Industrial demand is real and increasingly strategic. Electronics, solar, electrification, applications where substitution is difficult or costly. Meanwhile, investment demand swings violently because silver is the beta version of monetary metal. It tends to move more than gold in both directions. When the dollar system is stressed and confidence fractures, gold often moves first as the reserve asset. Silver lags, then sprints, because once capital flows shift from paper hedges to physical collateral, silver's tightness shows up as a squeeze dynamic. Undeniable. Now connect this to the target everyone argues about, $300 silver. That number sounds absurd if you treat silver as a calm commodity priced by marginal jewelry demand. It sounds less absurd if you treat silver as a small market sitting under a mountain of leveraged claims in a world where the dollar system is forcing a reset in collateral and confidence. If the next liquidity squeeze forces central banks and fiscal authorities into another round of emergency responses, liquidity facilities, backstops, balance sheet expansion under new names, then the expansion phase returns inside the crisis phase, and that is when metals stop being a trade and start being a valve. Gold becomes the credibility hedge. Silver becomes the convexity. In that environment, the paper market can only suppress price as long as the physical market is willing to accept promises instead of delivery. Once delivery becomes the question, pricing changes character. Check. So here is the present day sequence cleanly. Treasury issuance and auction dynamics pressure yields. Real yields and term premium tighten conditions. Funding markets show strain through repo, swap spreads, and basis. Leverage trades unwind, amplifying moves. FX absorbs the stress through dollar strength and global currency weakness. Inflation and deflation transmit simultaneously through different channels. Debt rollovers convert rate stress into solvency stress. Volatility forces forced selling. And then the monetary metals reassert themselves, not as a narrative, but as a settlement alternative. Verified. What should you do with that, practically, without becoming the liquidity exit for someone else's leverage? First, stop watching only the silver chart and start watching the machine. Watch treasury auctions, bid to cover, tails, and who is absorbing supply. Watch real yields, not just nominal yields. Watch term premium indicators and long-end behavior, because that's where confidence shows up. Watch repo conditions and signs of collateral stress, spikes, specialness, rising haircuts. Watch swap spreads for balance sheet strain. Watch cross-currency basis for dollar funding stress abroad. Watch credit spreads and equity volatility together. When both widen, liquidity is leaving. And in metals, watch the divergence between paper price and physical reality, coin and bar premiums, delivery times, warehouse inventory drawdowns, and reports of tightness at the wholesale level. Undeniable. Second, adjust your mindset. In the crisis phase, the first move is designed to make you quit. It sells the thing you wanted as protection and makes you feel foolish for owning it. That is the trap. The goal is not to time the bottom. The goal is to understand which phase the machine is in and to avoid being forced to sell into the squeeze. That means sizing positions so margin cannot evict you. That means holding some liquidity so you can act instead of react. That means preferring structures that survive volatility rather than chase it. Check. And finally, accept the core warning with full clarity. This time is not different. American exceptionalism is not a force field against math. Tech will save us is not a monetary regime. Modern optimism is not collateral at a treasury auction. When the system is overextended, it must reprice. When funding tightens, it must liquidate. When confidence fractures, it must migrate toward hard collateral. The only choice you get is whether you recognize the sequence early or whether you become the exit liquidity when everyone else realizes it at once. Verified. If you want to stay ahead of this, keep your attention on the plumbing, not the pundits. And don't let the first liquidation convince you the mechanism is broken, because the first liquidation is the mechanism working. The next time we meet, we'll go deeper into how the machine was built to demand dollars at the worst possible moment and why that design choice makes the next stage sharper than most people can imagine. Undeniable. When the dollar system starts searching for oxygen again, will you recognize the sound before it reaches your portfolio?